Then on March 15, 2023, in New York City, a critical incident began to unfold within the global fintech landscape. The main actor in this unfolding crisis was a prominent financial technology company, TechTrade Solutions, which developed a widely adopted algorithm for high-frequency trading. This algorithm was leveraged by hundreds of investment firms and banks to optimize their trading strategies and manage portfolios in real time. It interfaced directly with various financial data feeds, aiming to assess market conditions and execute trades accordingly. On this particular morning, engineers at TechTrade Solutions attempted routine maintenance on the algorithm, which had been operating without significant issues for over a year. However, during this process, a technical failure emerged from an overlooked dependency on a third-party data provider. This external source was responsible for delivering real-time market data crucial for the algorithm's risk assessment calculations. A subtle but critical misconfiguration in the API settings inadvertently allowed for incomplete data streams to be received during high-volume trading hours, creating discrepancies in the algorithm's output. As this misconfiguration played out, the algorithm began returning inaccurate risk assessments. Certain trades were overvalued, while others were undervalued, creating confusion in asset pricing. This malfunction triggered a cascade of erroneous trades executed based on flawed risk evaluations. The initial hours following the incident saw a rapid inflation of stock prices in some sectors and drastic reductions in others. By midday, the market had experienced a notable volatility spike, visible through the rapid oscillation of share prices and major indices. The first measurable impact of the incident materialized quickly, as market analysts reported a staggering 10% drop in the Nasdaq Composite Index by 2 p.m., amounting to losses exceeding $1 trillion across the board. Market confidence plummeted and trading volumes surged as investors attempted to understand the cause of the rapid shifts. Notably, many firms dependent on the TechTrade algorithm found themselves on the receiving end of unpredictable losses, with some reporting declines of up to 25% in their portfolio values within hours. As panic spread throughout the trading floor, employees across investment firms flooded internal communication channels with urgent queries and bewilderment regarding the algorithm's performance. Inside TechTrade Solutions, confusion reigned. Engineers and product managers gathered in an emergency meeting to discuss the unfolding crisis. Initial internal emails indicated an assumption that network latency might be contributing to the observed discrepancies, which led to rapid diagnostics aimed at verifying system health rather than pinpointing the misconfiguration. Meanwhile, an incident channel was established within their communication platform, but the sheer volume of messages quickly overloaded the stream, complicating the response efforts. Some engineers rushed to implement partial fixes, such as recalibrating algorithm parameters and applying temporary limits on trade size, intending to mitigate further losses while searching for a comprehensive solution. Yet, these quick fixes were often based on incorrect assumptions about the underlying issue. External signals soon began surfacing. Users flooded social media platforms with reports of trades executing at nonsensical prices. Some traders even shared screenshots of erroneous buy and sell confirmations, raising alarm among retail investors. Public monitoring services triggered alerts for unprecedented market fluctuations, and financial news outlets began to pick up on the story. Headlines described the puzzling volatility, with minor mentions of a technical glitch at TechTrade Solutions. These articles, however, lacked clarity on the true scale of the issue, suggesting it was a temporary anomaly rather than a systemic failure. The algorithm's failure soon attracted the attention of regulatory bodies who launched preliminary inquiries into the incident. Trading firms that relied on TechTrade's algorithm were left scrambling, trying to piece together a response that would protect their investments while simultaneously gathering all available data to make sense of the situation. As the hours progressed, communication between TechTrade Solutions and its clients grew strained. Several firms expressed increasing frustration over the lack of clear information regarding the validity of their trades, while TechTrade's engineers were internally debating whether the issue remained isolated to their systems or if it indicated a more significant breach in their infrastructure. By the end of the trading day, as market close approached, the gravity of the situation grew undeniable. A new wave of trading reactivity emerged, driven by panic. With the sun setting over Wall Street, there was a palpable tension looming above the financial districts. Investors were left with pressing questions about the resilience of a system that rested on a precarious foundation. Observers from various investment firms began forming contingency plans, wary of their heavily reliant trading algorithms. In response, Tech Trade Solutions initiated a comprehensive audit of its algorithm, but the inadequacy of its existing logging and monitoring tools quickly became apparent. As night fell on March 15th, the ramifications of the day's events were already echoing through global markets, and the long-term effects of the algorithm malfunction started to materialize. The anxiety around potential losses continued to mount, fueling speculation about further collapses. Decision-makers at TechTrade knew they were on the brink of a much larger crisis. Inputs from external sources suggested that the initial reports were only the beginning, as whispers of a deeper vulnerability within financial technology began to circulate. The full extent of the chaos promoted by this minor bug was just beginning to take shape. As March 16th began, the trading desks were in disarray. Panic selling set off a chain reaction as companies struggled to assess exposure to the unpredictability stemming from the TechTrade algorithm malfunction. Many firms recorded staggering losses throughout the morning, leading to an unprecedented sell-off that affected thousands of stock listings worldwide. By noon, the cumulative impact of erratic trading patterns triggered widespread outages across major stock exchanges, including the New York Stock Exchange and NASDAQ. The growing concerns eventually forced federal regulators, including the Securities and Exchange Commission, SEC, to issue an urgent statement asserting they were monitoring the situation. Market watchdogs intensified scrutiny, and requests for transparency led to the immediate halting of numerous trades that displayed abnormal pricing. As the hours ticked by, a significant percentage of the global trading volume was effectively frozen, leading to a liquidity crisis that amplified fears among investors. As the trading day progressed, some major firms began, and subsequently struggled, with the implementation of emergency risk management strategies. An increasing number made the choice to drastically limit trading activity to avoid exacerbating losses. This resulted in a wave of internal chaos, where critical decision-making diminished amid an atmosphere of uncertainty. By the end of the day, more than 1,300 stocks faced substantial trading suspensions as regulators sought to mitigate the effects stemming from the faulty algorithm. On March 17th, the situation escalated further when several key players in the financial sector formally filed notices to Tech Trade Solutions outlining their grievances and losses incurred due to the failures. At the same time, the company acknowledged a deeper issue within its programming that went beyond mere technical latency, but rather indicated a cumulative failure of integrated systems intended to safeguard against such anomalies. Recognizing the potential for legal ramifications, Tech Trade Solutions initiated emergency measures that included a full algorithmic reevaluation and sought partnership with cybersecurity experts to conduct independent audits of their operating systems. They also issued a temporary suspension of the affected algorithm, while regulatory bodies launched an official investigation into the circumstances of its failure. As the news cycle continued to evolve, more revelations came to light. Leaked internal communications suggested that engineers had flagged potential risks regarding the algorithm's dependencies weeks prior to the incident, but were thwarted in addressing them due to project timelines and resource limitations. This information was confirmed during a later press conference by TechTrade's leadership, further complicating the narrative around accountability as the media scrutinized the events leading up to the malfunction. In the following weeks, damning evidence surfaced through court filings, revealing that failure to communicate vital information among TechTrade personnel directly led to the mismanagement of the crisis. Journalists highlighted these key findings, and financial analysts began to quantify the implications of the glitch. Estimating global financial losses had surpassed $500 billion by the end of the evaluation period. As investigations intensified, regulatory bodies sought deeper legal recourse against Tech Trade Solutions. In April, Tech Trade was subpoenaed to provide detailed documentation of their algorithmic design, process, and maintenance logs. Law enforcement became involved as suspicion of potential fraud related to the manipulation of stock prices was raised during the discovery process. Schooling personnel faced interrogations, and company executives were urged to testify. By June, amidst mounting legal and financial pressure, Tech Trade Solutions commenced a restructuring process. Leadership changes ensued, with several high-level executives resigning, acknowledging a failure in oversight and communication leading to the disaster. Despite these efforts, the company's reputation suffered irrevocably, with significant clients withdrawing contracts and investments. In the months that followed, stakeholder dissatisfaction culminated in regulatory reforms enacted across the financial technology segment, emphasizing robust risk management protocols for firms relying on algorithmic trading systems. In early September, Tech Trade Solutions faced bankruptcy proceedings, unable to recover from the tidal wave of losses and litigation that rippled through the industry. In conclusion, the algorithmic failure of Tech Trade Solutions led to a significant market upheaval, revealing stark vulnerabilities within global trading infrastructures. As of October 2023, Tech Trade Solutions has ceased operations, and many of its operational components were absorbed by larger firms as part of a settlement agreement to protect users and restore some semblance of market stability. The lessons learned from this incident continue to resonate through the regulatory landscape, but the ultimate impact of this seemingly minor bug manifested in irreversible changes to the fintech and trading environment as a whole.